You're staring at your financial aid package, or maybe you're looking at multiple offers from different private lenders, and you have to make a choice. This isn't like choosing a meal from a menu where you can just pick what looks good today. The student loans you choose now will be your financial companion for the next decade, or even 2 or 3. Make the wrong choice, and you could be locking yourself into a rigid, expensive debt that limits your life options. Make the right choice, and you will have manageable payments and safety nets that protect you if life takes an unexpected turn. So how do you know which loan is the right one? It's not just about which one has the lowest monthly payment right now. The right loan is the one that offers you the most flexibility, security, and lowest total cost over the entire life of the debt. In this video, I'm going to give you a simple but powerful 5-step framework for choosing your student loans. We'll move beyond the hype and the fine print to focus on the factors that truly matter for your long-term financial health. This is about making a smart, confident decision that your future self will thank you for. Step 1 is non-negotiable. Always exhaust your federal student loan options first. I cannot stress this enough. This is the golden rule of student borrowing. Your first stop should always be the financial aid offer from your school, which will include direct subsidized and unsubsidized loans. Why are these the foundation of a smart borrowing strategy? Because of the safety nets. Federal loans come with a suite of borrower protections that are mandated by law. These include income-driven repayment plans that cap your monthly payment at a percentage of your income, loan forgiveness programs like public service loan forgiveness, and generous deferment and forbearance options if you hit a financial rough patch. These are not just minor features, they are financial airbags. You hope you never need them, but if you do, they can save you from financial ruin. Private loans do not have these protections. They are a rigid contract. So, your first decision is simple. Accept the federal loans in your package before you even consider looking anywhere else. If there is still a gap after maxing out your federal loans, then and only then do you move to Step 2. Step 2 is to get crystal clear on your actual need. How much do you really need to borrow? This is where many students make a costly mistake. The financial aid package might show a loan offer that covers the full cost of attendance, but that number includes estimates for things like transportation and personal expenses. You do not have to accept the full amount. Before you accept any loan, create a detailed budget for your actual school year. Calculate your exact tuition, fees, and if you're living on campus, room and board. Then, realistically budget for books, supplies, and essential living expenses. The difference between your available resources like savings, scholarships, and income from a part-time job and this total is the actual gap you need to fill. Borrowing more than this amount because the money is available is one of the biggest drivers of unnecessary debt. A pro tip here is to remember that you can always accept a lower loan amount than what is offered. If you have a $5,000 offer but only need $3,000, only accept $3,000. You can often request more later if your situation changes, but it is much harder to give money back after it has been disbursed without paying interest and fees. Step 3 is where you start comparing specific loan terms, and this is the most detail-oriented part of the process. If you've exhausted federal loans and still need to borrow from a private lender, you must shop around. Do not just go with the first offer you get or the bank your family uses. Get rate quotes from at least 3 different lenders, banks, credit unions, and online lenders. When you compare, you're not just looking at the interest rate. You need to look at the annual percentage rate, or APR, which includes the interest rate plus any fees, giving you a truer picture of the cost. Is the rate fixed or variable? A variable rate might start lower, but it can increase over time, adding risk and uncertainty. A fixed rate gives you predictability. Look at the repayment term. A longer term means a lower monthly payment but much more interest paid over the life of the loan. Look for any hidden fees, like origination fees, which are a percentage of the loan amount taken right off the top before you even get the money. Use a student loan calculator to understand the total cost of each loan, not just the monthly payment, but the total amount you will have paid by the end of the loan. This is the true cost of borrowing. Step 4 is to honestly assess the practical requirements and your own financial profile. For private loans, this means confronting the cosigner question. Most undergraduates will need a cosigner to get approved or to get a competitive interest rate. Having a cosigner is a huge ask. It means that person is legally obligated to pay the loan if you cannot. It impacts their debt-to-income ratio and their credit. It's a serious commitment that requires open and honest communication. Before you ask, have a plan. Show them you've done your homework, show them the lenders you're comparing, the rates you've been quoted, and your plan for repayment. For all loans, but especially private ones, ask yourself, what is my likely starting salary after graduation? A good rule of thumb is to try not to borrow more in total for your entire education than you expect to make in your first year as salary. If you're pursuing a career with a typical starting salary of $40,000, you should strive to keep your total debt below $40,000. This simple check can prevent you from becoming overwhelmed by debt that is out of proportion to your income. Step 5 is the final gut check. Consider the exit strategies and your future self. Before you sign, ask these final questions. What happens if I can't find a job after graduation? With a federal loan, I can go on an income-driven plan with a payment as low as $0. With a private loan, I have no such option. The full payment is due. What happens if I want to go back to school? Can these loans be deferred? What if I become permanently disabled? With federal loans, there's a discharge process. With private loans, it's unlikely. Choosing the right student loan isn't about finding the one with the absolute lowest interest rate today. It is about choosing the loan that gives you the most options and the most protection for the unpredictable journey ahead. The right loan is the one that allows you to invest in your education without mortgaging your future flexibility. Follow these steps, borrow only what you need, and prioritize security over short-term savings. Your future self, the one who wants to buy a house, start a family, and save for retirement, will be incredibly grateful you did. Before we finish, a critical disclaimer: I am not a licensed financial advisor or a loan officer. The information in this video is for educational and informational purposes only. Loan terms, interest rates, and federal programs are subject to change. You must always consult the official government student aid website at studentaid.gov, your school's financial aid office, and your loan servicer for the most current information. It is your responsibility to read and understand the terms of any loan agreement before you sign. Consider consulting with a qualified financial professional for personalized advice tailored to your unique financial situation.